Welcome, everybody. We're going to get started in just a moment. Thank you for your patience. We're just letting people in from the waiting room. Thank you. Okay, we'll get started. I think most of the people are coming in from the waiting room. I just want to welcome everyone. I am Babette Henderson. I am the Senior Director of Alumni Engagement for the Feinberg School of Medicine, and I'd like to welcome you to our Building a Better Estate webinar. This webinar is sponsored by our Half Century Club, and our Half Century Club recognizes our alumni who graduated 50 plus years ago, and we're really grateful to be partnering with them on this informative programming. Please be on the lookout for further Half Century Club events, including our kickoff event in July. Just to note, we're going to be sharing this recording and the slides from the presentation after the event. Right now, I'd like to introduce our moderator for the event, Camille Licklider. She's the Executive Director of Gift Planning for Northwestern's Office of Planned Giving. Camille earned her bachelor's degree in music from DePaul University and a JD from Valparaiso University of Law. Camille has 20 years of experience in the gift planning field and is delighted to be at Northwestern, where she's led us in the gift planning team since 2012. In her role as executive director, Camille leads a diverse group of professionals that include frontline gift officers and gift planning specialists. Camille works closely with the medical school's development team, and in particular, Larry Kuhn. She finds great joy in helping medical school alumni achieve their estate and charitable plan giving goals. Camille will introduce our presenter, and she's going to also moderate our Q&A session after the presentation. Camille?
Thank you, Babette. I am so happy to be here with everybody today. I noticed some familiar names when I looked at the attendee list, and just want to let everybody on today's session know that we are all at Northwestern in development, looking forward to being able to meet with many of you in person again. I want to thank everybody who submitted questions in advance today and make you aware that we will be looking through those at the end of the presentation. They were great questions. We look forward to addressing them. As additional questions arise during today's session, please go ahead and submit those in the Q&A button on your screen, and we'll try to get to as many questions as possible today. Before I introduce today's speaker, I thought it would be fun to get us started with a poll question. And that question is, and by the way, when you are ready to answer the poll question, please go ahead and type your answer into the chat. We're interested in knowing where our audience members are at in the estate planning process. So for example, are we at the very beginning, or at this time, maybe you have not yet engaged an attorney and you don't have a plan? Would you say you're kind of midway through, maybe in the process? Or would you say you've completed the process, everything's been executed and you're feeling good about it? So haven't started yet, midway through, or all done, ready to move on? And I'll give people just a couple seconds here to respond. All right, at this time, I'm looking at the chat and I'm not seeing any responses. Oh, actually, okay, go ahead and type them into the Q&A. My apologies, I just received a note. My apologies. Go ahead and type your responses into the Q&A. Thank you for your patience. Thank you, everybody, for helping with this. Excellent, great. Got a lot of responses coming in here. All right, so I am seeing a really diverse set of responses. I'm seeing many of you have completed them. Many of you are just starting. Some of you are midway through. All right, fantastic. Well, I can tell you that you've absolutely come to the right place. And so knowing that we're all at various stages in the process, I think this is a perfect time for me to introduce today's speaker, Shannon Hartzler. Shannon is a partner in the Trust and Estates Group of Levenfeld Pearlstein, where she concentrates her practice on estate planning and administration. Shannon listens to her clients to understand their specific goals while incorporating tax and administrative efficiencies. Clients trust Shannon to help them solve sensitive and often complex family and business issues at the planning stage to avoid later conflict that may arise after a client dies or perhaps becomes incapacitated. Additionally, Shannon helps clients form charitable organizations and provides guidance that moves their charitable work forward for generations, which of course, we love to hear that. Shannon's active in her community in a number of ways, including her membership with the Estate Planning Council, the Chicago Estate Planning Council to be specific. Shannon received a JD from Valparaiso University School of Law, a Master of Music and Musical Theater from the Boston Conservatory, and a BA from Goshen College. And I came to know Shannon a couple of years back when she was working with a benefactor who was in the process of putting the medical school into his estate plans and coming up with some very wonderful ideas and specific terms. Shannon brought such tremendous expertise to that process, along with a very genuine desire to meet both her clients' goals and to understand Northwestern's goals. And she brought this to every conversation that we had throughout the process. And little did I know that in addition to being a great collaborator, Shannon and I share a couple of things in common. We're both Valpo law graduates, as you heard mentioned in our biographies, and we both have this background in performing arts. So you never know, you might see us on the road someday, violinist and the singer, and maybe a couple of others behind us. But for today, I think we'll stay with the charitable estate and charitable gift planning. So with that, I turn it over to you, Shannon. Take it away.
Thank you very much, Camille. It's really an honor to be here today. I'm a big fan of Northwestern, and Northwestern doctors have literally saved my life twice. So you could certainly call me a grateful patient as well. So we're here to talk about estate planning. I think we can move on to the next slide. And the next one. Thanks. So to understand about estate planning, you need to understand how assets pass when you die. And assets are going to pass in one of three ways. And it's kind of like a hierarchy. At the very tip top of the pyramid is a joint tenancy with a right of survivorship. When you own an asset as a joint tenant with a right of survivorship with someone else, when one joint tenant dies, the other joint tenant automatically owns the asset. And that's just by operation of law. You don't need to have it won't matter if there's a beneficiary designation on it. It won't matter if you have a will that says something different. Just operation of law, it automatically passes to the surviving joint tenant. The level below that on the hierarchy would be passing by contract. And most people experience that as beneficiary designation on things like life insurance and retirement accounts. So when you have an asset that is passing according to beneficiary designation, that's the way it's going to be paid, period. It won't matter if your will says something different. And then the level below that is your estate plan, which is a will, sometimes a revocable trust, we'll get into that later, and or lack thereof. And when you don't have an estate plan, every state has what we call the default rules of descent and distribution, or intestacy. And that is where if you die without anything in place and you have assets that aren't passing according to joint tenancy and aren't passing according to beneficiary designation, then they're going to pass according to these default rules. If you are married with children, some portion of those assets are going to go to the spouse, and some portion of those assets are going to go to the kids. I have a lot of clients that are really surprised saying, oh, you mean it doesn't all go to my spouse? Well, no, it doesn't. There's going to be a portion that goes to your kids. And if your kids are minors, that can be a mess. And if you don't have a spouse, or if you just have a spouse and no kids, typically it goes all to the spouse. If you have kids and no spouse, it's going to go all to the kids. And if you don't have a spouse or kids, that's when state law, and this varies from state to state, then they start looking at relatives like parents, siblings, sometimes even nieces and nephews. But I want everyone to understand, if there's one takeaway from this slide in front of us right now, I want everyone to understand that your estate plan is not just your documents. How your assets are titled and your beneficiary designations are just as integral a part of the flow of assets when you pass away. Next slide, please. So why should you have an estate plan? If there are default rules in place, why? Why? Well, I think of an estate plan as a love letter to the people that you leave behind. That's really what it is. The primary goal of any estate plan is simply the smooth transition of assets. I've certainly administered a number of estates where there wasn't proper estate planning in place, and the transfer of assets was messy and expensive after the person passed away. A next goal of any estate plan is simply minimizing taxes. I mean, estate tax, sometimes we think of it as a voluntary tax, because for many people it is. It's a tax that can be minimized or even avoided altogether with proper estate planning. And you also need to think about asset protection for beneficiaries. And I have a lot of clients come to me saying, well, my beneficiaries, I'm not worried about them. They have their financial stuff together. I don't think I really need to worry about asset protection for them. And my response is always, if you have any beneficiary that might get married in the future or is now married, yes, you do. Because the world's most common creditor is a spouse in divorce. I mean, that's something that can happen to anybody. I mean, my experience has been that otherwise very happy and well-adjusted people frequently marry the wrong person. And that can definitely trigger a need for asset protection. And sometimes, and you can have things that can happen to anyone, like car accidents, personal injury claim, that can happen to anybody. Another goal would be planning for minor beneficiaries and beneficiaries with special needs. When you don't have an estate plan in place and assets end up going outright to minor beneficiaries, a lot of the time you're going to be stuck with a formal court guardianship. And that is a pain in the neck and something you can avoid completely simply by making sure that any assets passing to a minor pass to the minor in trust. And with respect to beneficiaries that have special needs, if you have a beneficiary with special needs who's receiving government assistance, then that beneficiary could lose that assistance if they receive a bunch of assets from you outright. They'll be forced to spend down their inheritance before they're even going to qualify for government benefits again. Then they got to go through the whole reapplication process. Whereas if you'd simply put that inheritance in the correct kind of trust for that beneficiary would be able to continue receiving their government benefits to cover the basics. And then the assets that you've left them can give them a more comfortable lifestyle than they would otherwise have had available to them. Reason number 5 is probate avoidance. Probate, for those that don't know, is the formal court process of transferring assets at death. And probate isn't always the end of the world. And sometimes you even want it. If you're in a car accident, there's a personal injury claim out there against your estate, I'm going to open a probate as fast as I can to cut off that potential claim. But most of the time, for most of my clients, probate is something I like to give them the option to avoid. If you have assets and you make sure that everything is passing by joint tenancy, beneficiary designation, or has already been funded into a revocable trust, which we're going to discuss in a little bit, so that it's just passing under the trust when you die, you can avoid probate altogether. And that's a bunch of hassle and expense that you can just save. And then last but not least is maintaining your privacy. Probate is a public process. Now, that doesn't mean that everyone gets to see everything you own, but it is something where, for example, in most states, when you die, even if you don't have a formal probate, you still have to file the will with the court. And then once filed, that will becomes a public document. If you have an estate that's been prepared to avoid probate, where you have a revocable trust in place, that will is the most boring document in the entire world. It just names your executor, it names guardians of your minor children, and then it just pours everything into your revocable trust. And one point that's not on this slide that I do want to make sure everyone is aware of is that if you have minor children, you'll need to name guardians of those children in your will. Now, I don't know the law of every state in the union. In Illinois, when you name guardians in a will, it's not binding on the court because the court will always make decisions in the best interest of a child. But it's a powerful suggestion that's rarely rejected by the court when you're naming the people in your will that should look after your minor children when you pass away. Next slide. All right, so now I'm going to talk about the basic estate plan documents. I've already mentioned the will. Your will, again, is just a document that says, when I pass away, my assets are to be distributed as follows. And then you name an executor in your will. Your executor is the person who is in charge of gathering your assets and making sure they get transferred to your beneficiaries. Your executor is also responsible for paying your creditors and notifying people that you have died. And you also name guardians of your minor children if you have minor children. And then if your estate plan involves a revocable trust, it's just going to pour your assets into that revocable trust. Now, a revocable trust is a trust arrangement that you can enter into during your lifetime. You enter into it during your lifetime, and you can revoke or amend it at any time. You are the grantor of that revocable trust. You are the person transferring assets into the trust. That's what the word grantor means. And you are usually your own trustee of your revocable trust. Now, you don't have to be. You can name someone else's trustee if you want to, but most people prefer to be their own trustee. So they still have all the same control, all the same power over their assets that they had when they were titled in their individual name. And there's really no difference between you and your revocable trust while you are alive. A revocable trust is not an asset protection vehicle. And any creditor can still reach the assets in that trust. Everything is just reported under your social security number. The reason to fund assets into a revocable trust while you are alive is that if you become incapacitated, the person you've named as successor trustee just goes in and takes over. And it's a smooth transition instead of having an agent with a power of attorney for property having to run around to like 10 different institutions. The other reason to have the revocable trust and fund that with your assets while you are alive is the probate avoidance aspect. And when you pass away, your revocable trust is the document that includes the key provisions of your estate plan. So really that's your core document. Very easy to change, amend, or revoke. But when you die, your revocable trust becomes a separate taxpayer. That's when we would assign a new tax identification number to it. And all the assets are going to be transferred according to the plan that you have in that trust, which typically involves tax planning, putting some assets in trust to shelter it from taxes, leaving other assets to a spouse if you have one, and then making sure that any assets to young beneficiaries are transferred to those beneficiaries in trust. The other two documents that are core estate plan documents are your power of attorney for property, which you still definitely need even if you have a revocable trust. A power of attorney for property is a document where you can name an agent to handle your financial affairs. And you can make this document effective immediately, so your agent can go out and take action on your behalf, even if you're not incapacitated, or you can have this document be effective only on your incapacity. The reason you still need a power of attorney for property, even if you have a revocable trust, is because there's some assets you cannot fund into a revocable trust, like retirement accounts. So if you become incapacitated, it's your agent under power of attorney for property who's going to be filing your income tax returns for you, paying the bills, and making sure that your required minimum distributions are taken out of your retirement accounts if you're at an age where that needs to be happening. And last but not least is your power of attorney for healthcare. I'm sure that pretty much everyone in this webinar is probably very familiar with the power of attorney for healthcare. It's a document that I encourage my clients to think very carefully about, because a lot of clients are like, oh, it's the pull the plug document. It is so much more than that. In my experience, sometimes being a healthcare agent can be a very long-term role, where especially for a client who has a condition that's putting them into slow decline, like a cancer or dementia, your agent under power of attorney for healthcare can be doing a lot of constant interference with your doctors regarding meds, rehab facilities, nursing homes. We also, in the powers of attorney for healthcare that we prepare at our firm, we also make sure that those documents include disposition of remains. So if you had any very strong feelings about burial or cremation or where you wanted to be buried, we'd put it in that document. And we also include organ donation sections so that you can indicate your preferences for organ donation. And yes, of course, end of life care, whether you would want fluids and nutrition to be continued or discontinued. Next slide, please. So, as I mentioned, the estate the estate and gift tax. The estate plan documents ours certainly include tax planning because you want to minimize or avoid estate tax altogether. Now, estate and gift tax under current law, each individual can transfer up to $11,700,000 per person who is not a spouse and not a charity without incurring an estate tax. The top estate tax rate is 40%. The top gift tax rate is 40%. Now, the thing to know about estate and gift tax exemption is that this is actually a single bucket. You can use it up during your lifetime by making large lifetime gifts, and then you would have less to apply to your assets when you die. And that's not at all a bad thing, not at all. You know, it really depends on your individual situation, which you would want to look at with your attorney and your wealth advisor if you have a wealth advisor. Next slide. The next slide to be considering is, if we can go back one slide, is generation skipping transfer tax. Generation skipping transfer tax is a tax that occurs when you transfer assets to a skip person. A skip person is someone who is 2 generations below you. So if you are transferring assets to a grandchild, that's a skip. You have an exemption under current law of $11,700,000 for generation skipping transfer tax, and again, a top rate of 40%. Now, it's important to plan for these taxes because when you die, for example, your assets could be subject to income tax in the hands of the beneficiary, depending on what it is, estate tax, and also generation skipping transfer tax. Like all 3 taxes could apply. And so you'll want to speak with your lawyer to make sure that your plan is considering all of the taxes that might be involved so that you can minimize or avoid them altogether. Next slide, please. Yes, changes on the horizon. Our whole firm has had a lot of questions from clients about the proposed changes to the estate tax that have come under the current administration, and that is really a moving target. There's been proposal to reduce the $11,700,000 exemption per person down to $3,500,000. And that is scary for a lot of people because something that not everyone knows is that your life insurance proceeds are included as part of your taxable estate when you die. So I have a number of clients that think they don't have taxable estates, that once you've added in several $1 million worth of life insurance proceeds, are completely taxable. They're also talking about raising the estate tax rate from 40% to 55%. Now, no one knows what's going to happen. I don't have a crystal ball, that's for sure. Now, my personal opinion, this is just my personal opinion, is that the changes are very unlikely to be passed as they have been proposed. I mean, Congress always involves a lot of compromise and many changes before anything is passed. And then also, I think it's my personal opinion. This is, again, only my personal opinion. I could be wrong, but I don't think that any change is likely to be effective this year. I think we're looking at changes that are likely to be effective next year. And that's something, so it gives us some time to plan for potential changes. Something else to be aware of is that your individual state may have a state estate tax that you need to plan for as well. I'm in Illinois. I know that not everyone on this webinar is in Illinois, but if you're in Illinois, Illinois does have a separate estate tax, and the threshold for Illinois estate tax is only $4 million. And so all of these changes are moving pieces and parts, and this is a great time if you don't have a plan to get with your advisors and see if you need a plan. You probably do. And if you already have a plan, to re-examine it and make sure that assets are still likely to flow the way you want them to flow, even if these changes go through. Next slide. So why charitable giving? I think that charitable giving is the ultimate way to control your legacy. Now, I do have some clients, when they're looking at a tax that's likely to be inevitable, they're like, the government's a charity. That would be 0.00001% of my clients. Most clients do not want the money they've worked so hard for to go to the government. That's not what they want to do. They would much, much rather have those funds go to their family and to the institutions and causes that they feel passionately about. And honestly, for a lot of these people, tax savings is a secondary goal. I mean, they have charitable intent from the beginning. That's really very important when it comes to any kind of charitable giving, is that you have that intent up front, that you're like, okay, I really want to support X. X cause is really important to me. Charitable giving is also something that I consider to be sort of a gateway drug to good financial stewardship. I have so many clients ask me, how do I talk to my kids about wealth? You know, there's many clients that are reluctant to tell their children just how much the family has. And I can understand that reluctance, certainly. But I think that kind of hesitancy is very understandable, but it's been my experience over my years of practice that it's better to talk to children about wealth early and often. And charitable giving is a great way to do that. It's great to sit down once or twice a year as a family, allocate X amount and say, hey, how do we think this amount should be spent among all these different charities? What's important to us as a family? And hey, kids, what do you think? Where do you think we should give these funds? One way to do that is through a donor advised fund. A donor advised fund is a separate fund that you set up, and it's held at a public charity, and the public charity administers the fund. So when you contribute assets to the fund, you're getting an immediate deduction for the contribution. I mean, you're giving up control of that fund. Those assets are not yours anymore. They have been permanently committed to charity. And then you advise the charitable organization on how those funds should be spent. So that's when you can get around the table once or twice a year and say, hey, we have our donor advice fund. Where do you think we should ask the charity to allocate these funds this year? I understand that Northwestern does have a donor advice fund program. Can you tell us some more about that, Camille?
Sure, I'd be happy to. Our donor advised fund program is known as the Compass Funds. The title of the program is something that came out of many of you may remember Northwestern University's interest in having alumni think about their Northwestern direction. What was your story before you came to Northwestern, and where are you going? Where are you headed now that you graduated? And all of you on this call have gone on to do so many wonderful things. So with a Compass Fund at Northwestern, you can absolutely set up a DAF just as you would at Vanguard or Fidelity or any other large commercial entity that now has a charitable giving program, which includes a DAF program. Our program has been around about 3 years. And a donor simply gets in touch with us, and we do the heavy lifting in terms of putting together the donor advised fund agreement. We will then, work with donors on things like how often are distributions going to be recommended out. We will help with, reporting out to the donors about what's happening with the fund in terms of both its investment performance, but also reminding donors what grants have been made out of the fund. We do ask that 50% of what is distributed out of the DAF, if Northwestern is to be the sponsor, we ask that 50% remain with Northwestern. And that's a pretty common, I think, guideline among universities who choose to administer these funds. We're, I think, among a handful of universities that have taken the step of establishing our own program. We're excited about it. We've had a few takers, and it's funny, when you were talking, Shannon, I was thinking about one donor in particular whose children are still fairly young. But he did say to me on the front end that one of the reasons he was doing this with Northwestern is because of how much he loves the university. He hopes that he can sort of, he brings his kids to a summer camp at Northwestern every year. And he thinks that by talking to them about the DAF that he's set up with us, he'll encourage them not only to be charitable throughout their lifetimes, but perhaps even to be charitable towards Northwestern, which would be great for us. We do have a minimum that we require on the front end of $250,000 to set up a DAF with our program. And it's, we're really excited about it. And we just sent out a newsletter that featured this program when we had a number of inquiries. So we're excited. We'll see if we can get a couple more in there. Hopefully that covers what you were thinking about.
Absolutely. Next slide. So the next kind of charitable giving, I like to think of these as revocable commitments because they're very easy to change until you die. So you can adjust them as your wealth goes up or down, or as your charitable intent changes. One of the easiest things to do is just simply making a bequest to the charitable organization under your estate plan documents. This is typically made of cash or marketable securities. Those are very easy to value. They're easy for any organization to accept. Using non-liquid assets, definitely you'll want to talk to the university or other charitable organization before you try to give them real estate, your yacht, or livestock. It might be really complicated for them to accept the asset. There might be ethical issues around accepting the asset, or perhaps the costs of converting the asset to something the organization can use might exceed the value of the gift. It just depends. And I'm gonna talk a little bit more about that with Camille shortly. Another kind of very easy and super tax efficient way to get assets to charity is to name them as the beneficiaries of your traditional IRAs or 401ks or 403bs. When you name a charity as the beneficiary, it's deductible for estate tax purposes. So you've got a big savings there. And what's beautiful is that unlike an individual beneficiary, the charitable organization is not going to pay income tax on the gift. This has become even more important after the Secure Act was passed in 2020. It used to be, before the Secure Act, that, right now, if you leave your retirement accounts to your spouse to continue to take those out over his or her lifetime. That has not changed. That was true before the Secure Act was passed. It's true now. But for non-spouse beneficiaries, it used to be that a non-spouse beneficiary could put it into an inherited IRA and take the funds out really slowly over his or her lifetime and pay income tax in little dribs and drabs. That is no longer true. Now, the maximum amount you can get with a non-spouse beneficiary in general is 10 years. Now, there's some carve-outs for that, beneficiaries that are disabled. There are some carve-outs, but for the most part, a non-spouse beneficiary, you're looking at 10 years, and they have to take it out. So these assets are worth far less in the hands of non-charitable beneficiaries than they are in charitable beneficiaries. Like a non-charitable beneficiary could be getting as little as 30 cents on the dollar after estate tax has been paid and income tax is paid, whereas a charity is getting the whole thing. You are benefiting the charity, like completely. And so that's just a really tax efficient way to reduce your estate and to direct assets to the causes you love. Next slide. So when you are giving property that is weird, as in not cash or marketable securities, or you have a specific purpose for your bequest, I cannot stress to you enough how important it is to be in conversation with the institution to accomplish your goals. I remember I was working on an estate plan for someone who wanted to endow a chair at his alma mater, but he wasn't even giving 7 figures. And there was simply no way that the university was going to be able to accomplish the gift with the amount he wanted, his goals with the amount he wanted to give. It was still a valuable gift to the university, just not for the specific thing he wanted to use it for. So when you are looking at giving unusual, non-liquid assets, or you have a specific use for the gift, you really should talk to the university. Now, if it's something as simple as like directing it to, the School of Medicine or, the School of Business, that's typically not an issue. But a lot of the time, someone might have a more specific goal for the gift. And that's when you want to sit down with the university, articulate the goals for the gift, and find out what kind of oversight is in place to ensure that your goals are achieved. And I've had a lot of clients that are worried about confidentiality in those situations. I have never, not once in my entire career, encountered any university that would not honor confidentiality, like ever. That's just not even an issue. Usually organizations are very, very happy to work with their donors to achieve their purposes and to keep things completely anonymous. Camille and I actually met over just such a situation. Camille, do you have anything you want to say about designating bequests for specific purposes?
Sure. I can just add a couple of things to the great points that you've already made, Shannon. First of all, with regard to illiquid assets or something that's just harder to simply accept and put to use right away, I cannot underscore enough the point you made about getting in touch with us sooner rather than later. Northwestern tries to be as flexible as it can be with regard to these kinds of assets. However, it does take time for us to review them. There's often a committee involved. For example, with real estate, we have a real estate gift acceptance committee that meets and reviews what is being proposed by the donor. That's very easy to do when the donor is alive. If it's something that we're receiving from an estate, we try again as hard as we can to be flexible and to accept the illiquid asset. But on occasion, we may have to say to the executor or the trustee, sorry, we're disclaiming the bequest. We can't be flexible enough to figure this out. That's very rare, but it does happen. It can be avoided though, if and when a donor and or a donor's advisor comes to us, me or somebody on my team in the gift planning office, as well as somebody like Larry Kuhn or someone on his team in the medical school, and we can work some terms out on the front end together. So that's an ideal situation. And then with regard to specific bequests and terms and the way that you were describing, Shannon, we have a couple of options. Often I or someone on my team will hear from Shannon or a donor and they'll say, this is what I have in mind. And we will draft bequest language that we then deliver to the attorney. And the attorney says, yeah, I like this. I might change a little bit, plops it into a will or trust, and we're good to go. Another option that we really like is crafting what we call a separate writing that is incorporated by reference into the will or trust. So it's usually a memorandum of understanding or a letter of intent, can be as long as we need it to be. Often we'll have donors maybe make some revisions to what we propose. Maybe somebody like Shannon might make some revisions. And then we have this beautiful document that we all sign, but that we know can be amended over time. But in the will or the trust, the language is fairly brief and refers to that separate document. And it might also state, for example, if it's endowed, it might say for an endowed fund, the terms of which are more clearly, or more further details, et cetera. And that is, I think, very beneficial for all parties and probably the most flexible approach. So we have found that to work really, really well. And we appreciate it when the gifts actually come in because we're able to look at this document. Somebody else in our office is looking at this document and says, okay, we have this money coming from this estate. Here's exactly what we do with it. Here's the account into which we place it, et cetera. So thank you for this information. This was really great. And for the chance to talk a little bit more about it.
Great. Thank you. Next slide. All right, so I want to talk about some techniques that my clients have been asking me about. Since we are in such an uncertain environment, I have clients saying, hey, I really want to reduce my estate, but I'm worried about not having a stream of income when I retire. So there's two common methods to address that. I want to address charitable gift annuities first because they're so simple. The donor and the charity enter into a contract where the donor makes a contribution of cash or securities to the university, and the charity agrees to pay a fixed amount to the donor for life. So every year you're getting this set amount. You get an income tax deduction for the present value of the gift. And since you've bought this, you have some basis in it, income payouts are only partially taxable to you. So because part of that is a return of your basis. And if for those who don't know what basis is, if you buy something for $6, your basis in that item is $6. That's your basis. So a beautiful thing about the annuity payments is that they can be deferred. So if you want to get the deduction now while you're earning more money, but you want to wait until you are retired, if you're retiring soon to get the payments, you can defer those. And then you're getting the payments in retirement when you're earning less. And so what income tax you are paying on the payments is less. I understand that Northwestern does have a charitable gift annuity program. Camille, do you want to say anything about that?
Yeah, I'm looking at our time, Shannon, so I will be very, very quick. We do have a charitable gift annuity program. We love it. Some of you that are attending today are familiar with that program. We've got probably about $30 million in assets in our gift annuity portfolio, and we hope it continues to grow. We have a minimum of $15,000 to set one up with us, and the donors that do it absolutely love it. It's a win-win for everybody. So get in touch with us if you're interested in learning more.
Great. All right, next slide. And I'll make this very quick in the interest of time. Another technique that I want to tell everyone about is a charitable remainder trust. This is when you set up a trust for a non-charitable beneficiary who can even be you as the donor. It doesn't have to be a third party. And that person has a life interest or a term of years interest. And you can structure the payments either as a fixed annuity, like with the charitable gift annuity, where you're getting a set amount every year, or as a unitrust amount, where every year the trust is valued and then you get a fixed percentage of that trust, like 4%. Then the trust remainder, it goes to charity for whatever purpose you've designated in the trust. So you get an income tax deduction for the present value of that remainder interest that's going to charity, estate tax deduction upon death. Now, I love charitable remainder trusts because the IRS has forms for them. So I know exactly what I need to do from the IRS to prepare the correct charitable remainder trust for your needs. However, administering a charitable remainder trust is no joke. It can be a complicated process. And so it's good if you have a sophisticated trustee, someone who knows what they're doing in administering this trust. And Northwestern can serve as trustee of these, correct, Camille?
Yes, we can serve as trustee. Again, we have a fairly large portfolio. We do all of the heavy lifting that's required. We have an outside entity with whom we partner very closely as our agent. And they do a fantastic job of making sure income payouts go out on time, that all the tax paperwork is done properly. We also have some templates that we can supply to donors. They're the IRS specimen documents, even further tailored. Additional review has been done. So we're happy to serve in that role. And it's a really important part of the work that we do in the gift planning office. So thanks for mentioning that.
Great. So that brings me to the end of my presentation. We have some questions that we received.
Yes, I'm excited to start sharing some of those. So I will start with those that came in beforehand, and then we'll see if we can get to any of the others. All right, so one question was, where do we start and what do we need to research prior to meeting with an estate attorney?
Okay, most of my own referrals have come by word of mouth through happy clients. Definitely talk to your friends, and also from wealth advisors. Wealth advisors often have a list of attorneys with whom they work, that they trust, that they know are going to do a good job for their clients. And they'll often have like a range of costs because not every client needs X level of attorney. It just depends on what you own, where you're at with your assets. In terms of having a really efficient meeting with your estate planner, it really will help you out if you come prepared with a personal financial statement. And that's simply a list of what you own, how it's titled, and the approximate value of those assets. Like some clients will have something that their wealth advisor has prepared, which is awesome and fantastic. And other clients will write it out for me on a piece of notebook paper. And I can work with that too. That's fine. But it's really good if you have that ready ahead of time so that you know what you have, what it's worth. And also if you have your beneficiary designations, you should know what those say.
If things change, so I think the example that this person gives, if I move or so if I have a change in my primary home, or you can think of any other myriad of changes, how often should I be changing my trust?
Okay.
It's an interesting question.
In general, whether you move or not, we strongly recommend that you just look at your estate plan once every 3 years. That doesn't mean you have to call your lawyer. Take it out and look at it. And make sure that the people you have named as your fiduciaries, your executors, your trustees, your agents for power of attorney for property and healthcare, make sure those people still make sense. That's usually what people want to change. But if you've had a big life change, like divorce, or you've sold your business, or you are, when it comes to moving, that is a big life change. Definitely time to look at things. If it's only a move, usually I just change the powers of attorney for the state where you're going to be living as a resident, because it makes life easier when banks there and doctors there are looking at forms with which they are familiar. You might not need to change your will or trust, but you might. It just depends.
All right. I'm looking at, we've got some really good ones coming into the chat as well, but here's another one that was pre-submitted. What's the difference between estate planning and asset protection? So for example, if I have my primary home and investment properties and trusts, how do I pass them on to my children?
Okay, there is no difference between estate planning and asset protection.
Right, that's what I was, people use them interchangeably, right?
Yeah, absolutely, absolutely. And there's documents that I didn't even mention that we always encourage people to have as part of their estate plan, such as prenuptial agreements. I know that sounds very unromantic, but still, that's an important asset protection document. If you have your primary home and investment properties and trusts, well, that just depends on whether you set up those trusts or someone else set up those trusts and what the terms of those trusts are. If someone else set up those trusts for you, and that's what's owning your home and your property, you may not have an option of passing them on to your children. It depends on what the trust says. Sometimes you'll have what we call a power of appointments, where a beneficiary has a power to direct trust assets in a certain way, usually to a limited pool of people. And that might be one way to do that. But that's very individual to the specific trust involved.
Okay, here's one that just came in that I can answer very quickly. Are there any administrative expenses for a CRT? If Northwestern is the administrator, will Northwestern charge me or my estate? Generally speaking, no. We have our fee structure actually is very competitive, but there's a way that we net it out from the trust and try to minimize it as much as possible. At times, there may be a very small portion that's essentially what happens is it's removed from the gift at the end. It's the remainder gift that comes to Northwestern. The fees are pulled out of there. But again, we try to minimize those as much as possible. And for whoever submitted that, I would strongly encourage that person, feel free to reach out to me. We can talk more and give you some specifics. But by and large, extremely competitive and hardly anything at all there to worry about. Another one that was pre-submitted that I think is great for this group. What is the biggest mistake, Shannon, that you see mid-career physicians make in their estate plan?
Not having one. That's just the worst, when they don't have one at all. It's usually a giant mess. And if they own their practice as a business, that can be a real mess, because part of an estate plan is also, for anyone that has a business, it's business planning as well. I, as an estate planner, get our corporate people involved. If I need to get, a buy-sell agreement in place so that a business asset is transitioned smoothly when someone dies or becomes incapacitated. Just no planning is the biggest mistake.
Here's one that came in today. Do I have to place assets into revocable trusts before death, or can they automatically go into a trust upon death since this is a springing trust? And I think you got into this a little bit in your presentation, but I thought it might be helpful to address it again. So you want me to reread it, or are you good?
I'm good. I get the question. Okay, so if you set up a revocable trust and you have your will passing your assets to your trust when you die, and you never fund that trust during your life, fine. Everything is still going to pass according to the plan that you've set forth in that trust, as long as you don't have any competing joint titling or beneficiary designations. It's all going to flow through the trust. The difference is that then 99.9% of the time, I have to have a probate. I have to open a formal court probate to get the assets into the trust. And so you have that added level of hassle and expense. If you fund the assets into your trust while you are alive, then I can usually avoid a formal court probate, because you don't have enough hanging out there in your individual name that I would need to go through the court to transfer. Because it's already in your trust. And when you die, it just passes according to the terms of the trust. The other advantage of funding a revocable trust while you're alive is simply consolidating your assets under a single umbrella. And that doesn't mean a single account. You can have a revocable trust of 20, 30, however many accounts, but you take the fiduciary aspect, which is the trustee, under a single umbrella. And so if you become incapacitated, your successor trustee just takes over. That's all they have to do.
I really like this one, Shannon. Do you have any tips for U.S. citizens living abroad? And this person mentions Australia, Singapore, and England.
Okay. Yes, I do. And I'm going to make this quick because this is really very complicated. When you are living abroad, you need to speak with local counsel, and you also need to speak with your accountant in the US, and certainly an accountant in the country in which you are living, because you can be deemed to be a resident of that country. Even if you're only living abroad part of the year, depending on how much time you spend there. And that can affect what you're doing. And when you own assets in another country, they might not be able to flow according to your estate plan. For example, there are some places like France that have forced heirship over certain assets when you die, and you don't have the option of transferring them to just anyone you want, because they're going to go by operation of French law to certain people. And so definitely speak with your attorney, an attorney in the US and also in your country of residence, and also an accountant in the US and in your country of residence. And hopefully people that have some international experience so they can spot those issues and work together to resolve them.
All right, fantastic. And one last one. Could you speak generally the range of costs on this question? the range of costs for estate planning, which I know are pretty wide. And then I don't know if you can talk specifically about costs for your firm. That was also asked, but maybe just generally, the range.
Okay, range of costs. I mean, it is really, really wide. And a lot of it is driven by what you need. I've had clients that maybe their assets weren't, 80 million plus, but they had so many weird international issues that it was more expensive. It depends on what you need and what is going on with your individual family. My current firm usually does things on a flat fee, and that flat fee varies depending on what a client needs. But other firms that I have worked at have done things strictly on an hourly basis. And so it depends on what it is. And that's like not really probably the answer you were looking for, but it's the honest truth.
All right, fair enough. All right, well, I'm looking at the time, and I want to be respectful of everybody's time. So let me begin the closing by, first of all, thank you to the audience for such great questions. I know we didn't get to all of them. We hope that you'll be reaching out to some of us after the fact to get those answered. Shannon, I want to thank you so much for your time, for all the great information that you shared, for being willing to do this, and for letting us know, how important Northwestern is to you. So thank you, thank you, thank you. Lastly, I want to acknowledge there was a large number of people behind the scenes. Nobody, that's on this webinar can see them, but there are a number of people who did a ton of work to help us to get to this place. So thanks to all of you for your work. You know who you are. We will be sending out the event recording and some contact information for everybody following this webinar. So in addition to, seeing it on, I think, do we have the final slide up? I'm looking at a couple of things on my screen, but I know that's up on the final slide as well. Know that you will be receiving that. You will be receiving a special communication from the medical school. And Larry and Kuhn, whose name you'll see on the slide, and Shannon and I, who've been speaking with you today, we all, hope to hear from you in the future and wish you all the best of luck with your estate and charitable gift planning. So thanks to everybody, and I think we're going to end just on time.